So let's go ahead and get started with our audience. I'm not sure how many will actively end up going here, but there are 13 people that are still 11 people now unassigned. So hopefully in about maybe about a minute here, we'll have everybody that's sitting in the main conference room assigned out to their breakout rooms. So we'll give it a couple seconds. I'll see my notes there as when I get started, but we'll do introductions as to who we've got on the pins that you'll see up top here, what they do, what they're trying to do, and then we'll just kind of open it up to a couple of general market comments, and then we'll get into if anybody has any questions, comments, or concerned. As mentioned earlier, this is the multifamily breakout room, so that will be our primary topic. I do know that all of us on the phone here or on the screen here have experience in other product types. So while multifamily is our focus, if there's something that you would also like to just ask, you've got the experts here. So it looks like hey, Randy, it looks like everybody's been assigned to the rooms that they've been assigned to. AJ, why don't you, I'm just going to go across the board here. Why don't you start off with a quick introduction on yourself, what you're doing, and then we'll go to Fred, Carrie, and David.
Perfect. AJ Bellino, Regions Bank, Regions recently acquired my previous company, Sabal. We are a nationwide agency lender, and I obviously saw our preferred asset class, multifamily. We lend all over the country, every single market, Fannie Mae, Freddie Mac, both small, balance, and conventional programs. And we've got CMBS to catch the outliers. If you've got something a little quirky on a deal, maybe it's SRO concentration, maybe it's short-term rental concentration, maybe the bathrooms aren't compliant. There's little things that we can roll into our CMBS program. Really, if there's news for us and the agencies, it's quite simple. The agencies are famous for lending everywhere, which is really nice. But credit boxes are tightening somewhat. Maximum leverage programmatically is still 80%. Minimum debt service coverage programmatically is still 120. But underwriters are beginning to take hard looks at transactions. So if you've got a multifamily deal that you think's a tweener or that you just want to get a take for what the agencies give you, give me a call. I can probably have a solution worked up for you in a space of 10, 15 minutes, just let you know if you've got a dog that hunts, and then we can drill down further if you'd like. AJ Bellino, Regions Bank.
It's really only 120. Interesting. I'd heard a 140, but so it's good to know that there are lowers out there.
Oh, there are. You've got to hit a couple hurdles to get there, but you can get there.
Perfect. Fred.
Thank you, Eric. Fred Ornelas, Axos Bank. We are headquartered in San Diego. We are classified as a neobank or a digital bank, which is basically a bank without a physical branch network. We operate on a nationwide platform, and though we do finance all asset types, I believe Arnie put me into this group because we do more multifamily than anything else. Our minimum loan amount is $500,000, and then we lend all the way up to $250 million. So covers a wide range of loan. What we're known for is doing deals with a little hair on them, or deals that don't typically fit in your typical credit box. So the type of product that we're bringing in right now, they're usually value add plays. So we have the ability to still project rents, and things are a little tight, but as the money-centered banks continue to move to a more conservative credit box, we are holding by offering that value add play. Again, the ability to project rent. So even if you had a deal that had a negative debt coverage ratio, it could be down to like a 0.1, or vacant building, or 0.5 on in-place rents, with a solid plan, a value add plan, rehab plan from the borrower, we'll go ahead and use those projected rents. There's typically no holdback. If there is a holdback, it's very minimal. And then typically we're at 65% of the purchase price. Yeah, certainly, times have gotten a little more challenging. And in the past, we were at 75 and then we lowered it to 70, but we're still active at 65. We remain extremely busy. And I think that's in part due to the credit box for the lenders out there shrinking. And so at Axos Bank, we're still trying to put money out. And usually, in addition to having a good, solid borrower, we use credit enhancements. So there could be indirect, like if you're willing to bring deposits in to our bank, we might be able to stretch on LTV. So truly a bank that looks outside of the box. And yeah, that's pretty much, that summarizes Axos Bank.
Perfect. Thanks, Fred. I appreciate it. So, Carrie, I'm going to have you go next. While you're taking yourself off mute, I'm going to make a quick announcement. If all of our panelists, AJ, Fred, Carrie, David, could put your contact information in the chat box, that'd be great. So, Carrie, let's hear from you.
Sure. So Provident Bank is, we're statewide. We'll lend in all counties, although we prefer to stay away from rural, super rural areas. We do mostly multifamily, but we are still lending on office buildings. Typically not multi-space. We'll lend on owner user office without a lending or a banking requirement. We'll lend on medical office space. We lend on self-storage and mobile home parks and clean industrial. We're not lending on retail. We're great for people kind of starting out in commercial lending. We are a full doc lender. So if you've got someone with 100 million in assets and 100 different entities, it's going to be very tedious. But we're great for, like I said, first time people getting, or not necessarily just first time, but people just getting started into commercial, because we'll lend down to 350,000 up to 6 million. And we love the Inland Empire. We're based in Riverside. So the Inland Empire that a lot of people try and steer clear from, we love that area. So
perfect. Great. Thanks, Carrie. David.
Hello, gang. This is David Rosenthal with Curtis Rosenthal, commercial real estate appraiser and once upon a time former corporate banker with Security Pacific way back in the day.
Recovering banker. Good to know.
Recovering banker, absolutely. I'm proud to say that this year we are celebrating our 40th year in business. I co-founded the firm in 1983. So I was 12 years old at the time. Anyway, so we've been around a long time. We know what we're doing. We cover for multifamily, particularly mostly Southern California, but most areas of Southern California. I've got 2 offices, one on the west side near LAX, and the other one, Carrie, in the land that you were just sharing about in the Inland Empire. I've got a very active office in Rancho Cucamonga, and we do a lot of business in the Inland Empire and love doing business out there. So what are we seeing in the world today? It's really tricky. It's a tricky time to be an appraiser because it's a tricky time to be an investor or a borrower. But we're still seeing some activity. Volume has slowed down quite a bit. But there are still buyers out there, particularly cash buyers, which doesn't help people on this call. But interestingly, I was at a group breakfast meeting this morning listening to a multifamily broker who was telling us about a recent listing. He had a property, he put it on the market at 3.2. Thought the better of it and ended up deciding he talked with his client, ended up putting it on the market at 2.8 instead of 3.2, thinking maybe he was being a little too aggressive. He ended up getting 16 offers and ended up selling the property for 3.3 with a very quick close. So there are still investors out there. They're active. The cost of financing is certainly impacting valuations, but honestly, not as much as we would have expected it to have by now. There are a lot of people talking about the distress wave that's coming and the refinance wave that's coming, and we have expectations of where we think that will lead things. But frankly, as appraisers, our job is not to project the market, it's to read the market and see what people are doing today. And as of today, while volume is down, there are still transactions. Pricing is off from where it was, of course, but it's not the deep discounting that we might expect given how much interest rates have increased. So if anybody has questions out there about valuation issues, if you have a particular property that you'd like some comps or a little local market intel or what have you, please give me a call. I've got a great team of people. We love to help. We love to work with our clients, and I'll share my contact information in the chat. So thank you very much, and look forward to your questions.
Great. Quick
One
question.
second. I'm sorry. Oh, go ahead. I was going to ask if I can, and I want to get your permission, Eric. I was going to ask David a question, but please go ahead.
No, let me give a quick one and then I'll tell you this. Can the panelists see the chat box? So Carrie, you just got a question. I'm just curious if you could see that there is a question there for you, if you can do nationwide. So if you can see the chat box as well, I won't ask those questions again. And then Fred, go ahead and fire away.
I'm seeing the chat box.
What's that?
Eric, for what it's worth, I'm not seeing the chat box in this view.
Okay, I will then, if I get questions, be able to do that. But Carrie, you got a question. Can you clarify?
Yeah, I
You'll be
can
able to
see
lend
it.
nationwide. Okay, cool.
I can see it.
Great. Can you clarify if you can lend nationwide?
Yeah, we're just in California.
Great.
And,
Thank you.
and Fred, if you move your mouse to the bottom, there's a chat button that appears.
I see it now.
Yep. Just want to make sure you were able to see that, so I didn't have to repeat. Fred, go for it. I know you had a question, so go ahead.
Okay. It was for David. David, I wanted to see if you can rank the property type in terms of demand. What is the most sought after property? And then just rank them from maybe multifamily all the way down, I imagine office. Do you have any insight on that?
Well, you probably just named the outer limits of the ranking. So actually, I think industrial is probably in the hottest demand right now, followed by multifamily. Retail, depending on the retail is still holding up pretty strong. Office is definitely bringing up the rear. Nobody likes office today. I think for most offices that we see, they're really highest and best use studies. As people are trying to figure out what do they do with that office. Even some retail, like single tenant retail with leases that are close to expiring. There's another interesting thing I heard from another broker at this breakfast meeting this morning. He had a single tenant retail property with 3 years remaining on the lease. And when he put it out to market, he got offers from investors at the lowest prices who were interested in either renegotiating the lease or bringing in a new tenant. Then in the middle, from developers who wanted to buy the property, tear it down and build it into something else. They were kind of the mid-level pricing. And the highest pricing came from owner users. And he ended up selling it to an owner user who paid cash and closed in 15 days. So highest and best use is really a big deal. With office buildings, from small office all the way up to giant downtown high-rise office, people are still trying to figure out what's going on out there and what is the future of commercial office. One thing that we've really noted particularly with office is that multi-tenant office investor buildings tend to fall into one of two categories. They're either healthy buildings that are well stabilized, over 80% occupancy, where tenants want to be because they know others are there and the buildings have services and such, or they're what I call sick buildings, where they're under 60% occupancy. They've got a lot of tenant issues. They've got tenant defaults. They've got people downsizing and leaving. Those properties, really the only market for them would be opportunistic buyers who are looking to buy at the lowest possible prices. Take, for example, the high-rise building that just sold in San Francisco. They just reported on it a couple of days ago. Class A high-rise, I think it sold for like $70 a square foot. Just unbelievable pricing, way below construction costs.
As they're selling before they lose even more money. One of the interjections that I would throw in there too is as you're thinking about which markets have adjusted the most, cap rates, you had industrial, you had multifamily all trading in the 2s and 3s and low 4s. Now they're in the 5.5, 6s. Retail was always kind of like a 6 and never really got below that. So I think you're probably seeing more demand on the ones where they're saying, oh my God, where are we now? Because of the variation now and where values are for those. So I would think office for sure is having the biggest swing. And so therefore you probably are trying to find a little bit more of what's going on there. Industrial and multifamily with their significant reduction in cap rates that took place over the last 3-5 years, those are now moving up with our interest rates. So now what's my property worth? And then retail just was kind of cruising along. So that's why I would guess, Fred, when you're asking that question, I would say probably the product types that are having the most motion in values or value swings. Value swings would be my short. But one of the questions I've got for the group too, though, is as you're seeing these opportunities, I know transaction volume is down. Valerie, I see you, and I'm now going to pin you there. Perfect. We'll get you introduced in just a sec. Is it refi or is it acquisition? So are you seeing people trying to get rid of their variable loan that they had earlier that has a 3-year expiration window and is now coming due? Or is it an acquisition financing? So AJ, Fred, Terry, Valerie, are you seeing refis or are you seeing acquisition loans mostly right now?
Actually,
Fred. Go ahead, Fred. Nope, sorry, Fred.
I am seeing a split, like it's a 50-50 for the refinances. The deals that I'm working on are deals where the note might actually not be due, but it's being reset. So they may have had a 3-year hybrid, it's fixed for 3 years, or an adjustable for fixed for 5 years, and then it's resetting. And usually on a lot of the loans out there, the reset, there's no initial cap. So you're seeing people that may have been at 4.25, 3.99, bump all the way to 8.5, and now, or they could be even higher depending on the spread, and they're looking for some relief. So I see that on that side. On the purchases, without a doubt, it is value add plays. And again, I'm not saying that we're doing a huge volume. Volume has diminished, but those that are out there that are transacting are looking for those value add plays. And yeah, so.
Thanks, AJ.
I'm seeing oh, hang on a minute. Let me make sure I'm not. Oh,
you're good.
I'm not perfect. I'm seeing a mix. I'd say 50-50. I'm getting people who are pinging me, asking for acquisitions. Oddly enough, I mean, it really kind of depends on the market. If we're talking about San Francisco, Los Angeles, Oakland, sellers are stubborn. The bid-ask gap is still there. Most deals that I'm doing, I can take down to a 120, but at existing rates, which right now with affordability are gonna, I know Arnie doesn't like us to do it, but I'm gonna do it anyway. You figure 565, 570 on the low end to about 6.25 on the high. 120 is getting you to 45, 50% LTV on your average 4.5 cap. And a lot of the acquisitions I'm getting pinged on are coming in right around that 4.5 cap. And that's 4.5 on contract, which means that if you're in a rent controlled market, that's looking a lot more like a 3. So haven't really seen sellers coming off that stuff. On the refinances, most of them tend to be cash in. And so I'm taking out a lot of 3 and 5 year deals that were done at 3 or 4%. And now we're doing them at, kind of middle of the road 6. So generally speaking, cash neutral, cash in. On rare occasions, I'll see cash out deals. Those are really tending to be concentrated in the Midwest. So if you've got sponsors in like the Ozarks, if you're looking, Oklahoma, Missouri, Arkansas, rarely if you're in North Texas, if you get down around Dallas or Houston, those deals tend to be pretty rich. And then on the East Coast, on occasion, I'll see deals, though those tend to be cash in as well. I mean, volume hasn't fallen. I'm a busy guy. I'm working till 9 or 10 o'clock at night. I just find that the hit rate it's not sponsors saying, hey, I don't want to do the deal. It's, hey, the deal doesn't work right now. Call me next week after we get the jobs report,
Right.
or figure out if the Fed is going to drop rates to 0 again or something like that. That's kind of usually
Right.
where we're at.
So I would, before I hit up Carrie on her answer that, so it sounds like busy versus productive per se?
I'd say that is accurate. Definitely busy versus productive. The only thing I'd add is that because transaction volume or deals actual closing are getting done, tend to tapered a bit. I'm finding that sponsors are a little more willing to lean in on things they can cure. So you can't cure cash flow shortfall or rent control, but you can cure a seismic issue, or you can cure a structural issue. And so there's a lot more willingness to lean in on reserves and get stuff done, only because I think looking ahead, I'm doing a deal in Santa Monica right now, and the sponsor's just like, look, I have to get this done. I've looked forward 24 months. Rates aren't going to get any lower. I might as well just bite the bullet and get it done. So they aren't happy refis. They're necessary refis. I think that's probably the best way to put it.
An unhappy refi. I love it. Carrie, I saw you smile when you heard the unhappy refi. It sounds like you probably had a little of that too.
Totally. Our 5-year fixed is 6.75 right now. And just like Fred said, where people are refinancing out of their 3.99s or their 5 years are up and they were at 3.99, it's definitely shocking for a lot of people. I'm seeing 50-50 as well. 50 purchase, 50 refinance.
Wow.
A lot of requests for a lot of out of the box stuff. No, nothing straight down the middle for sure.
Yeah. So I'm just curious though, if you were to weigh your portfolio, because I would think it'd be all refis right now, because I see transaction volume significantly down. In our markets, 100 units and greater, where we would have had the first half of this year, we would have had 200 transactions. We've had 40. 50 to 100 units where we would have had 300 transactions, we've had 60. But then below, where we had the 4 units and the 20 units, those are pretty much the same. But I would think because of all the loans previously done, that would completely outweigh an acquisition right now, because I would think there's just got to be a lot of refinance. Do you think people are just extending in place and begging to stay in place and say, hey, I know I'm on a 3-year at this, but can I just stay and kick the can down the road a little bit? Or the lenders kind of say, I'd love to help you out, but I need to add 200 basis points to that.
Yeah, we will refinance. If they want to refinance out, we'll be happy to do that at current market rates. So,
Right.
and then we've hit them with the new prepay. So there's not a lot of benefit for, refinancing out. I think a lot of borrowers are thinking, okay, well, at least I've got no prepay. And maybe if rates change in the next year, then I can refinance. So I think there's a lot of optimism out there. Whether that's reality or not is debatable. But I think that with a new prepay or with people coming in and having a prepay, it's hard. I think a lot of banks or credit unions that don't have a prepay option are really busy right now.
Got it.
That's what I've heard.
That makes sense. Valerie, you had a flat
Hi.
tire on your car, but you made it.
Thank
Why
you.
don't
Yeah, guys. I'm
Why don't you
back
do a real
home.
quick introduction of yourself, who you are and where you're with, and then we'll hit you with the same question. So give us the intro.
Okay. Hi, guys. Valerie Hafner, VP of Origination at Four Bigs. Hey, Fred. We're a HUD lender. Everyone knows this as HUD, 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 and I'm always pitching HUD. And in the last conference, I said that I was actually holding back on pitching HUD, and now here I am coming back and pitching more HUD because everyone is oddly enough asking me for it, which never has happened in my career. But I guess it's still considered cheap capital. And so on the construction takeout for HUD multifamily nationwide, we're at a 5.6 interest rate on the 35-year fixed non-recourse. And I think where people are coming to me also now is on the ground up construction, which I always have to pitch. But now they're coming to me saying, I don't care if it takes 12 months. I just want the rate in the long term, 40 years. And so we're back to pitching HUD where I was in, but we're heavily into bridge financing right now and bridging the gap also, I should say, with our equity piece. And so we're kind of reinventing ourselves. And so now we've become some sort of, equity lender as well. So bridging the gap is what we've been seeing. And so picking up the pieces, structuring deals where if, banks obviously have gone down on their LTVs and not everyone can put down 35-40% on, let's say, a purchase or even an add value play. So we're coming in with a mezz piece up to 80-85% if we can get to an 8% debt yield. 8% debt yield in LA. So again, depending on where it is, a rule of thumb is just 3% over cap rate is what we're chasing. And let's see. That's what we're doing mostly. These are the deals people are coming to me and unfortunately we want to be part of the we want to provide the senior capital or control the senior debt if we're going to be doing a pref, but it's okay. We don't need to control the first piece if we're doing mezz. So pref, we need to control the senior piece, mezz we don't. So that a lot of times people are asking for pref, but they already have the first in line. I've got this bank for 26 million locked in, and I'm like, yeah, we're not gonna do that unless we control the senior piece. So it depends what I see. A lot of deals. I'm doing a lot of refis, not a lot of cash outs. If that was the initial question.
Yeah, that's the question. Are you seeing more refis than acquisitions? Are you seeing both? And
acquisitions. Yeah, I'm seeing both because there's a lot of add value plays right now. Everyone wants to, buy an add value, and then that's when we come in and we can either JV or do a mezz on that add value play with really experienced developers only. And that's hard to find because then we look at their numbers and they don't make sense, and so their values are less than the cost, and it's a mess out there. But seeing deals, staying busy. We are a bridge lender in residential California. We're seeing a lot of that, and we're doing a lot of takeouts, like almost like a bailout situation with bridge lenders because they didn't find the exit. They can't, whatever it is, either their credit score is not good enough for conventional or the numbers don't make sense on the exit to either Fannie or just banks, regular conventional banking. So we're having to extend loans or put them into another bridge loan, which is, a faux pas, but it's getting done because people are understanding the situation more and more.
Perfect. David, what's your take on what you just heard there and what you're seeing? Are you, and then tell us who your primary clients are right now, if they're borrowers or lenders or what you got. So what's your takeaway from what you just heard?
I think that's the state of the market. There are still some purchases going on. So on the borrower side, I mean, we'd typically be engaged by the lender, but we're seeing borrowers that are finding ways to finance new transactions. On the refi side, it's tough. frankly, I think this is going to be a really good time for private debt funds to step up, because I mean, some people have the liquidity to do cash in refis, other people don't, so they're going to need some additional capital. And even though it's expensive, that's really going to be their only exit, short of losing their properties. And it's a shame, because I think over the next 6 months to year, we will start seeing lenders having to take back properties because the borrowers just can't qualify at the new loan rates. And that's the nature of the industry. When so much money was put out at such rock bottom rates, and those things are coming due, what penciled yesterday isn't going to pencil today. And as that happens, my expectation is that that will impact values over time. But boy, it sure hasn't really too much yet. But yeah, the activity today is definitely split between purchasers that are still looking either for stabilized properties, or opportunistic buyers who are looking for potential turnaround situations, and people that are trying to refi. But direct refis going through conventional lenders are tough. I really think the private debt funds are going to get much busier with that type of activity, just because they have a little more flexibility in how they underwrite.
Right, they can get up there. So Valerie, please put your contact information in the chat box. We've asked
Okay.
everybody to do that just so we can have that squared up. So you see the Fred, you see the question below. What are some of your amortization terms, purchase, refi? I'll have you go to the box, and then Fred, you raised your hand, so go ahead and fire away what you're gonna say.
Just ask Valerie a question.
Go for it.
Yeah.
With regards to the HUD loan,
Mhm.
have they improved the efficiency in terms of the processing time, and how would that fit with the purchase? Because before it took quite some time to process.
Can you hear me?
Yes.
Okay. Yeah, I mean, yeah, HUD's not going to change for anyone. COVID, banks collapsing, they don't care. No, it's still going to take 5 to 6 months to do a purchase. So what we've been doing all along is, if let's say there's an urgency on a purchase, we'll provide bridge. And because we understand our exit, we can do the bridge with, let's say, a bank with 1 point in, and rates, when the last time let's see, 6.5% on a bridge, which is pretty good. Last time I priced out. And so, yeah, so the time frame is still the same, unfortunately. The only time that HUD will cut the time in half is if you've just recently done a construction loan, and then you're just recently doing another one. That's the only time they'll cut anything in half as far as timing goes.
Okay, I appreciate it. And then I could touch on my programs too. I know that was a question, Eric.
Yeah, so Nathan asked this, and I think Carrie, thanks for posting that. What are your amortization terms for purchase and or refi?
Okay, so for at Axos, my most popular program is our mini perm. So, but it is amortized for 30 years. It's due and payable in 10. It carries a 1 year prepayment penalty. It's 1% for 1 year, and then it's gone. If you wanted to swap that out, we can swap it out in the secondary market and get you a fixed rate, probably in the 6.75% range. But again, what we're doing at Axos is primarily value add plays for multifamily, and the people we're working with, they're doing the rehab. They're going to fix up the property, get some trailing numbers, then probably go to someone like Carrie or one of the agency lenders to get a lower rate, because my all-in rate is running at about 8 to 8.25 for that, again on a mini perm month-to-month adjustable.
And 10 on 30. Carrie, I know you posted your terms. Why don't you go ahead and route them out just in case somebody can't access the.
Sure. We're 30-year amortization, and we're 30-30 for multifamily, and 25-10 for commercial.
Perfect.
Our longest fixed period for multifamily is 7 years, and commercial is 5.
Got it. So 5 over 30 and 7 over 30.
Yeah.
Great. AJ, you're on mute.
All right. Sorry about that. So amortization for us can be 30 years on every program. Length will be 5, 7, or 10 on the small balance stuff. On the larger balance stuff, we can get a little funky, 5, 7, 10, 12, 15, 18. And as it pertains to prepayment, yield maintenance is the most affordable by far. But with Freddie Mac small, we can get a little funky. 3-1 open thereafter. We call it a 3-1 and done. And we can slap that on 5-year deals and top markets. So if you're in a core market, which for us can be Sacramento, Oakland, San Francisco, Los Angeles, San Diego, Orange County, we can get you in with 5-year money, 3-1 open thereafter, full term IO. And pay for it a little bit on the rate. So you might end up somewhere in the 630, 640 range with affordability, maybe low sixes, which gets you through the rough stuff until you can refi out.
Got it. Valerie, I saw you put it in the chat box, but go ahead and verbalize it if you don't mind.
Oh yeah, just wanted to make sure everyone puts me down for, HUD, obviously FHA, construction takeout, and mezz and bridge. And so the amortizations on HUD, so everyone knows, on a purchase and a refi and a construction takeout is 35 years. And then the 40-year is the ground up construction. And we're doing a lot of, like I said, single family. So I don't know if anyone in this chat does a lot of that, but we have a huge team, a residential processing team. And then so we're really on the ball with that. There's a lot going on with all the non-QM stuff, because at this point all the bridge rates are pretty much the same as a residential loan, and just without the headache and the tax returns. So everybody is turning to, whether it be owner occupied or investment, to non-QM. So that's non-qualifying mortgages, and we're using bank statements and P&Ls and no documentation, no income documentation to get you set up. I'm in the process of doing a reverse mortgage. We do a lot of those. That's another topic, but yeah.
I love it. Hey, Fred, there's a chat question for you. Do you also have a fixed rate bridge program?
I would just say that the mini perm adjustable, I can swap it out. But again, we'd have to go through the swap desk, our swap desk, and get you locked in that way.
Brad, do you normally require a rate cap?
It's just the bridge product is it that we offer. We can go in anywhere from 12 to 36 months with a couple of 6-month extensions. But it is IO interest. It's a month-to-month adjustable. So I don't believe that we could swap that bridge loan out. The only one that we could swap out for a fixed rate. And again, that mini bridge kind of acts like the mini bridge acts like just your standard bridge. So hopefully I'm not confusing you. So yeah.
Joseph, did that get your question answered? Do you want to rephrase it?
Yeah, no, that answers it. Do you require rate caps on your typical 3+1?
No, we do not.
Okay.
Perfect. So as I probably should have said at the beginning, if you do have any questions, feel free to fire them out. This is going to be an open discussion. We're here to answer any of your questions. You can put them in the chat box. You can raise your hand, and hopefully I'll see it on the screen, or just say, hey, Eric, I've got a quick question. So feel free to chime out. But I'd like to kind of do some real quick rapid answer questions, which I know is difficult for my panelists, but I'm just going to ask the question. It's going to be yes or no, or up or down, if you don't mind. And no, I will not do the what inning of the baseball game are we in, because that is just about as tired of analogy as there can be out there. But so
Thank you.
yeah,
It's more of a cricket game than a baseball game at this point.
Exactly. So let's talk football. No. So interest rates, are we going to see an increase this year? And if so, how many? So Carrie, are we going to see an increase this year? And if so, how many?
We are under the impression that the Fed is going to raise rates once or twice more.
So yes, 1 or 2. That's your answer. Yes, and it'll be 1 or 2. Correct?
Yes.
Yes, and 1 or 2. AJ?
I say yes, and I say 2.
Yes and 2. Fred?
Yes, and 1.
Yes and 1. We've got it. We're Valerie, break the tie. What are you saying?
Oh my God, I was saying no, but I'll say yes because I said that they were gonna raise it. If they were gonna raise it, it was gonna be at least a quarter, so yes.
Okay, well, that was gonna be my next question. Don't jump the gun here.
Oh,
David,
sorry.
I'll let you chime in too, buddy.
I'd say yes. I'm gonna say 2 or 3.
All right.
Hate to say that, but that's my projection.
Okay, all right. And so per Valerie's question, between now and then, what will be the rate raises? So AJ, you said 1?
No, I said 2.
You said 2. Okay, so is that 20, does that make it 50 bips, or do you think it's gonna be 70? What's the rate?
I think you're looking at 25 and 25.
Okay,
And I mean, like, rationale's pretty simple. Job growth's still really strong, and you've got to see things level off, and they just aren't.
okay. Fred?
25, 25.
Okay, so you were 2 as well. Carrie? Valerie? It's the one on the left, Carrie.
25, 25.
There we go, Carrie.
Yeah, I think probably 25 and 25.
Got it. And do you think then, once they do that, how long will it be until they go down? Or do you think they're going to leave it flat for a while? Or do you think next year there's a chance it's going to continue to go up? So what does 2024 look like to you, Fred?
Flat for 3 quarters. No, 4
Flat for
quarters.
3.
Let's go 4.
All right, so we're done this year, and next year we're gonna leave it alone.
That is correct. That's what I think will happen. Election, yeah.
Gary, you're nodding.
Yeah, I think definitely with next year being an election year, I think it's going to be hard to raise it more, and possibly I think we're expecting it to go down a little, just
did say
because it's an
election year.
election year.
You
Yeah,
did
just
say
because
election
it's an
year.
election year. So,
All right, Valerie.
Yeah, I definitely, well, I was saying it was gonna go down as of the beginning of next year, so I'll stick to my answer. I think
Okay.
it'll go down next year, yeah.
Going down. AJ?
I say flat, and God, I don't want to be a doomsayer, but I'll just go ahead and break it down. It's going to be flat because the only reason you would want to raise it is to cut runway, and the people that you're going to be reducing cost for don't have runway to lend. There's zero reason to drop it. There just isn't. I mean, the cost of funds, I could understand wanting to incentivize lending activity, but the fact of the matter is that liquidity is eroding, deposits are going away, and there is a bunch of 3% paper that's not moving without significant discount. And until that gets mitigated, and I don't think that's a 1-year problem, I think that's an 18-month problem. I think
Okay.
that's a 24-month problem. So I think it's going to get there, stay flat, probably won't go up, but I don't see it coming down.
Okay, David?
I'm going to say flat with the possibility of a slight tweak down in the 3rd quarter of next year. As much as the Fed is supposed to be politically agnostic, I think there's some politics involved there. And I agree with Carrie. It's an election year, and yeah, why not make the economy look a little bit better than maybe it really is?
Okay, my next question, and I'm gonna premise this with this hypothesis, if you will. So I've been in the business since 1988, and I was there the stay alive till 1990 through 1995, where there was $0 to make any investments. And you saw like the San Francisco office building trade at $75. I've been around through 2000 where you had the dot-com bust, and I've been around through the 2000, 2008 financial, the subprimes, the Russian rubles, all that fun stuff. In my career, there's never been as much money that is willing to invest in real estate, both on debt and equity side, as there is now.
Yep.
So with that in mind, I want to talk distressed market. Do you think we are going to see, and a slight increase, a tsunami, a small increase, a subjective increase. I think you're going to see it in office, but not necessarily in multifamily. So is there going to be an increase in distress? Is it going to be a significant blip? And in what product types, other than office, because that's the easy gimme, are we going to see this in? Give you a second to think about that one, because I believe, and I'll state this also. So in my history, I was with L&R, which is now Starwood, the CMBS special servicer. I was also at auction.com, and we sold off billions of dollars a month for them in failed real estate. CMBS providers, if they're defaulting, if they're taking over something today here in 2023, it will not hit the market until late 2024, 2025 at the earliest on an REO, because they take their time working through this thing. So having said all of that, what does the rest of this year and 2024 look like as far as distressed real estate, increasing, decreasing product types, and who wants to go first on that one, just to set the stage for us? Carrie, you nodded. It's you. Carrie, go ahead.
Oh, that was intentional. Busted. You know, we have not seen any distressed properties at all. We have zero in our portfolio. We're a conservative bank. But that said, I'm hearing just horror stories of people still not paying rent in LA. And they can get away with it. So I don't know how long as a property owner you can carry that. So I can't imagine that there's not going to be any kind of distressed properties out there. Would not make sense to me. So I think what we are seeing is high-end residential multifamily is taking a hit. Obviously retail, a lot of people are getting out of markets. San Francisco, high-end shops are leaving. Office buildings, that's obviously, it's low-hanging fruit. But I don't know how long we're gonna not see distressed properties. That seems obvious to me.
Got it. So the crystal ball is a little cloudy on when we're through all this, because AJ, you alluded to the 18 months worth of crap we're going to have to work our way through until we get to a safe and sane or normalized market. So AJ, what do you think?
Well, I think that 18 to 24. But I also think that the drivers for that distress is stuff that folks aren't really comfortable talking about. Some of it's going to be driven by maturity, 3 and 5 year money, assets that were over levered. And I'll be really frank, it's not just guys who took deals up to max leverage at 3%. There are people who bought assets on the com and put value add loans on, thinking they were going to pencil at rents that were $6 to $8 a foot on the multifamily side here in the Bay Area. That shakes out to about $1 million hole on a $8 million asset. That's just one example. You've got others, institutional quality assets that are levered above 80, that have mezz pieces on them, that have pref equity. I don't even want to think about having to get through that, but that's coming because the rents that were targeted by those JVs are not going to make. In San Francisco, market rent was $8 a foot when those deals got put together. It's $6.50 right now. That's $1.50 Gulf. If you multiply it out on a 550 square foot unit across a 50 unit asset, where does that Gulf come from? That Gulf is loss. And the issue right now is who's going to pick it up. The mezz lenders are already ash and they know it. Your equity providers are probably going to squeeze operators, and operators are going to push back. And so what you're eventually going to see is operators giving up and tossing keys back. It may not be lenders chasing guarantees. It may be owners throwing up their hands, like Veritas on their CMBS portfolio. That is the other one that I want to talk about, because I am seeing that through a client. And I mean, my client may end up winning the deal. A sizable portion of that portfolio is very likely going to be spun off in the next 60 to 90 days. And you were right, that one took a while to come after the default, but it's here. And that's not, oh, look, we finally got through it. That's step one. So I think figuring out who's going to get the loss and carry the loss is going to take some time. There's going to be some tug of war, but because there's so much liquidity in the market right now and so much capital that's willing to be spent, this is historically different from the RTC time. This is historically different from 2008. In 2008, regulators didn't have a choice. Extend and pretend was the only thing they could do. Well, they can't do that now. You've got people who have liquidity that don't want to get rid of it, and regulators aren't going to care. they're gonna force the issue.
Right.
And yeah, that's 18 to 24 months of tough times. There'll be plenty of business for us to do, but there's going to be difficult conversations that have to be had.
Yeah, that'll be my follow-on question after we get Fred and Valerie's on this last one is are the regulators going to make folks mark to market, and are you ready for that if it happens, kind of a thing? And Fred, so back to the distress, Fred, are you seeing it, feeling it?
Yeah, that last question that scares me to death.
Yeah, I know.
It does. So I'd say yes, distress. With multifamily in general, here in SoCal, it really is location dependent. But I like to just touch on something more specific, and that is senior housing. So I've been getting so many calls on newer builds of senior housing. Those are under distress. I would say I get one call every other day for a nice large complex. And the reality is, for senior housing in particular, you've got some really high fixed costs, and there's a lot of competition. A lot of product is being still rolled out. Some of it hasn't been completed, but for that product that has been completed, I think that the borrowers, sponsors are feeling the pinch.
Before you jump off that, Fred, that's surprising to me, because we all talk about we're getting older, we're living longer, and senior housing is the new thing to do. But you're saying it's so cost intensive to run these things, and the rents aren't there, that you're seeing some defaults and potential problems with that? Is that what I just heard?
We do. I mean, I see it. That's the most in terms of product type, asset type, senior housing. They're upside down. Their expenses are massive. That fixed cost is a killer. And again, you're working with tenants that are on a fixed income.
Yeah.
And I found that a lot of them are having troubles with the lease up.
Interesting.
And good, solid A locations. Yeah.
Awesome. That's my nugget for the day. I love that. I was not aware of that. And I've got some senior housing brokers down out of San Diego. They're very active right now. So I'll be curious to tap into them and see what they have to say. Valerie, sorry. Let's get down to Valerie. Distress.
Well, yeah, distressed, I guess, because again, like Carrie said, people aren't paying rents, people aren't making their mortgage payments. That's in California, but the thing is, I'm seeing deals nationwide, so I can't really focus on California, and I can't say that that's all I'm seeing. But yeah, I guess, when they said they predicted a few years ago there was going to be blood in the streets, and I guess that's what we're kind of seeing now. There are big opportunities, and everyone's just there to just wait for it and grab onto it. Everyone's trying to hold on to capital. The banks are evaluating how they do business, and they don't want to make the same mistake, so they stop lending or slow down. So when that happens, that's where the debt funds come in. So they start cherry picking assets and raising the rates. So right now it's really bridge. And so there's a lot of powder in the street. So whoever needs it, it's going to be excessive. And if they're going to have to steal an asset, they're going to be able to.
Got it. Thank you.
It's with debt, money, or cash, whatever. Yeah,
Exactly. David, do you have a quick one for me? We're down to our 5-minute mark, so and I have one
You
more
bet I
question.
do. Of course, I have a quick one for you. Interesting, maybe a little different angle. You know, when COVID hit, the federal government sent out a lot of money to people in PPP loans, and other types of support. I think that's helping to create liquidity that people have out there. And my guess is, as part of this whole credit tightening process, I think the Fed is trying to claw some of that capital back into the system to recapitalize loans on some of these properties. And I think there are people that have that capital probably sitting in reserve that may be putting it back in to kind of tighten things up. I will say, I'm in touch with banking regulators at the FDIC and the Federal Reserve and the OCC through some other organizations. And the feedback that I'm getting so far is not that they're being super aggressive, not that they've been charged with being super aggressive, but rather they're trying to maintain safety and soundness in the system. And they would probably rather see lenders work things out in a manner that fits with the bank's policies and with the regulatory environment. I know that there's been talk about revising and updating some of the regulatory rules that they work under, but that's not happening right now. It's been kind of pushed down the road, which tells me there's a lower sense of urgency this time around than what we saw in 2008, at least for the moment. So yes, I think distress is coming. I think there will be a push for borrowers to put more money back into their properties to make for safer and more sound loans. And so far, I don't see the regulators being super aggressive, creating a disastrous environment. I think they would probably rather have a softer landing than a disastrous landing. That's my current projection.
Yeah, no, and I'm going to tack onto that too, because one of my folks who works in the distress world was saying that if they really wanted to, I don't know how many banks there are. Is it what, 3,000, something along those lines, 6,000?
4,000.
All right, so you got 4,000 banks. Of that, there are 200 today that are probably Silicon Valley or First Republic-esque, if you will, where they could be at risk. And if the FDIC or the regulators really wanted to, they could go in and show up on the Friday in the suits. So, but they've not done that because one, they're understaffed. Two, the staff they do have is probably still around from the 1990 ones and doesn't want to go after all these banks. But you're also saying, just as a philosophy, that they are not trying to be that aggressive and create the perception of the overall banking industry is going to fail, because obviously that was the headline as soon as Silicon Valley went down. Oh my God, the banking system as we know it is going to die. Is that what we're seeing? Is that they don't want these big headlines, that they're going to take their time, that they're going to let the market solve itself rather than intervene? I mean, we can go back to election year, but that's not really, I think, what's going on. Is that what we're hearing and seeing?
No.
I
AJ,
think so.
no. AJ saying no. David saying yes. What do we got?
I don't think that it's, the end times reaction or anything like that. I also don't think that regulators are going to force anything. But what I do think is that there was a time where a cash and refinance had to happen and there simply wasn't the liquidity to deal with it. Well, there is the liquidity to deal with it now. And so where a regulator may take issue is tacking on a 1-year extension to a loan that doesn't pencil to take out. Too bad, pay it down. And that's where David was right on the money. Let's get some, let's lever down if we have to. And so the liquidity exists for it to happen. And so after that first wave of pay downs, things are going to look interesting, because I'm curious to see, there are some sponsors who have massive exposure, and you may end up seeing some assets trade for less than they need to, because what's your resolution going to be? hand the keys back or pay your loan.
Right. So in other words, get some more skin in the game from the borrowers rather than come after the lenders for. So you're going after the individual, not the institution.
Exactly. And I think that will just serve what the Fed's doing anyway, which is trying to claw back unnecessary QE.
Got it. Well, you can see that, I think you all see a little sign on this that says you can leave the breakout room and that we're closing in 43 seconds. So one, I just wanted to thank my other 5 panelists, if you will, for being willing to tolerate me and share your knowledge, et cetera. So thank you very much for your participation. If you hit the blue button down at the bottom that says leave breakout room, that will take you back into the main session where we will continue either with dialogue or Arnie will wrap it up. So feel free to click the blue leave breakout session. And thank you again for everybody's participation, involvement, and all of your dialogue.
Thanks,
Thank you, Eric.
Honor.
You bet.
Good job, Eric.